Shortage of liquidity management tools is considered to be a serious issue hampering the growth of Islamic finance. Treasury management in Islamic banks is challenging for several reasons, one of which include managing the various interpretations of Sharia standards. In this episode of the program, we'll be discussing opportunities and challenges of Islamic banking and treasury management in Nigeria. Our guest today is Mr. AbdulWaheed Shitta, a graduate of banking and finance from Yabatech and Olabisi Onabanjo, University Ago-Iwoye, Ogun State. Shitta was the overall best graduating HND student in Yabatech and faculty best student in OOU. AbdulWaheed is a financial and treasury manager and also an Islamic finance enthusiast. Mr. Shitta joins us from Taraba State for the conversation today. Good afternoon. It is nice having you on the program.
Good afternoon. Thank you for having me. It's nice to join you.
You're welcome. From your short profile, which I must say is impressive. So let us start the conversation with the report on the total assets of the Islamic finance industry, which is expected to grow beyond $3 trillion in 2021. How will you describe the impact of the Basel III implementation on Islamic liquidity management at the global level?
Firstly, I would like to begin the conversation by talking briefly on the Basel Accord for the benefit of those who might not have a prior understanding of what it means. The Basel III Accord was initiated by the Basel Committee on Banking Supervision following the financial crisis, global financial crisis of 2007-2008. It was made to strengthen the banking sector across the globe. Its lays emphasis on capital adequacy and liquidity management of banks, amongst several other things. Basically, liquidity is the ability of a financial institution to balance its inflows and outflows. We say that when the inflow and outflow of funds is balanced, then such an establishment or such an institution is liquid. So liquidity risk can occur when mismatch happens, when there is a mismatch between the liability and asset, maturity of the liability and then the asset. So this is why the Basel Committee on Banking Supervision came up with that bold move to roll out the Basel III Accord. Now, amongst other things, the Basel Committee developed two minimum standards, which are the liquidity coverage ratio, which basically is meant to ensure the liquidity of banks within a short-term liquidity, within 30 days. And then there is the other one, which is the net stable funding ratio, NSFR, which is proposed to ensure liquidity of medium to long-term resilience against liquidity shocks of banks. So generally, globally, several Islamic countries where Islamic banking is predominantly practiced, countries like Malaysia, like Bahrain, like Pakistan, amongst others, they've come up to say that the impact of Basel III on Islamic banks or across the globe is relatively smaller compared to the conventional financial institutions, because of the fact that the model of Islamic banks does not support non-Sharia compliant securities or derivatives. Take for instance Nigeria, for instance. One of the most popular the short-term securities used is the Treasury bills, and we know, according to Islamic rule, that Treasury bills is not Sharia compliant. So this is a challenge for Islamic banks globally. Another reason why liquidity is a big challenge for Islamic banks under Basel III, as argued by some researchers, is that the Islamic liquidity market is underdeveloped in terms of the market itself, in respect to that. So in other words, Islamic liquidity instruments in the financial markets are less effective and less liquid than their conventional financial market. I already gave example of Treasury bills earlier. So although there is this body, the International Islamic Liquidity Corporation, that has made effort to address this challenge, still the scarcity of liquid assets or liquidity assets that are Sharia compliant is still a serious issue, and that's my submission on that.
Thank you very much, Mr. Shitta, for that elaborate answer. So for that elaborated answer, let's talk about the viable products. Developing viable product has been described as the strategic step to improving Islamic banking services as it concerns treasury management. So what are your views on this as it concerns treasury management?
Basically, we would say that Bible products, of course, for any establishment, when we develop Bible products, it goes to, enhance the establishment or the industry, as the case may be. So treasury management, generally speaking, is the management of funds and revenue, within the bank funds and revenue within the banking system. So basically, the treasury function of an Islamic financial institution is to, basically manage or essentially manage two types of funds, which are, depositors' funds and then the shareholders' funds. All right. The functions of, treasury management of an Islamic banking institution can be, the management of statutory reserve, liquidity requirements, amongst other things. However, one important point that should be mentioned is that regardless of the product that is developed in Islamic finance, we need to be sure that such products or such processes are Sharia compliant, meaning that they must be approved by the Sharia board or Sharia advisory board or Sharia committee set up by the Islamic financial institution in question. And another thing also is that regardless of the product, it has to take cognizance of the risk appetite of both the bank itself and the counterparty, which in this case would be the customers and all that. So that's my submission on that as well.
That was very enlightening, and I take your point around risk management. You see, risk management is also very critical. And what measures can be taken to strengthen it in Islamic banking and treasury management in Nigeria?
Risk management in finance is a very important one, because everything that a bank does revolves or circulates around risk. So risk management shouldn't be taken lightly, and I'm sure that most banks have a dedicated department for that handles their risk. So risk management basically refers to the process through which risk exposure of a bank is recognized, is identified, is analyzed, is assessed, and attempted to be mitigated rather. So to reduce or control the risk. All right. So basically, the issue of risk management, even in the conventional parlance, is taken seriously. But as Muslims and in Islamic finance, we take our rulings from the Sharia, which is basically the Islamic, the Al-Quran al-Kareem, and then the Sunnah of Muhammad sallallahu alaihi wasallam. So the Quran itself emphasizes or talks about risk management. Funnily enough, in Surah Yusuf, verse 67, when Allah was talking about the advice of the father to his children, that when he said, "La tadkhulu min babin wahidin wadkhulu min abwabin mutafarriqa," that they should not enter by one gate, rather they should enter by different gates. That goes to show us the essence of diversification. You should not put all your eggs in one basket. Rather, you should diversify the number of assets. Don't put your eggs in one asset. So a man should adopt precautionary measures against risks generally. Also, there's an hadith of the Prophet Muhammad sallallahu alaihi wasallam, wherein he told a Bedouin that he should tie his camel and then rely or put his trust in the Almighty, Allah. That goes to show us risk management. All right, now, in addition to Basel II, of course, the Basel Accord also talks about risk management. Basel II talks about credit risk, market risk, and operational risk of banks. All right. But in addition to that, Islamic financial institutions also face other kinds of risks because of the fact that because of their mode of operation. Right. They also face equity investment risks, which is associated with modes or contracts such as musharaka and mudoroba. Now, musharaka and mudoroba, it emanates from such. All right. They can also face performance risk, which can emanate from salam, contracts like salam, istisna, and ijara. All right. So measures or steps should be taken to mitigate this risk. And what are steps or ways through which these risks can be mitigated or controlled? One of such ways is that there should be proper documentation of contracts. The contract should be properly documented, and that the terms and conditions should be clearly spelled out between both parties. Sometimes ago I heard wherein somebody said that he was about to approach an Islamic financial institution for finance, and then when he was told that he would repay, he said, I thought it's free money. Islamic financial institutions are not, they are also business entities. The monies they roll out are for persons, and they are putting their money to get returns. So look at the mindset of such a person that he thought it's free money. So at the onset, when it is explicitly stated to him that you repay this money, he would know that, okay, I'm repaying, and further steps will be taken to ensure that it repays, the money. In addition to, documentation, there is also need to, ensure that the internal control is in place. There should be proper internal control, by the legal department and also the Sharia compliance board. All right. In addition to that, banks can also, Islamic banks can also take guarantees, particularly when it comes to non-performance of, contracts. We can take guarantee or indemnity as the case may be. Although nowadays banks are already include indemnity clauses in their guarantee forms. Of course, the two are different. Guarantee creates a secondary liability, while indemnity creates a primary liability. What that implies is that when the guarantor when the principal debtor defaults the guarantee, that's when we can meet the guarantor to repay us. But when it is indemnity, whether or not the principal debtor defaults, the indemnity, definitely, pay, or the indemnifier rather will definitely repay. So banks are enjoined to also, we can take guarantee in respect of that. Another way through which they can mitigate their risk, particularly when it comes to ownership of goods, is the taking of takaful, which is Islamic insurance. They can, take takaful. It's Sharia compliant, particularly when it relates to ownership of goods. Regarding credit risk, there is a particular credit risk, management tool or instrument that has been developed or advocated by scholars over time, and that is the Hamish Judea, which is a variant of the collateral in the conventional finance. In this case, the party who is seeking the financial assistance would come up with, a fund through which we will use to which the bank can hold on to if it defaults in making payments. So these are some of the ways through which banks can mitigate or control their risks.
You made some good points on what Islamic banks should leverage on in order to mitigate their risks, such as investment funds, the risk sharing. And let's look at the analysts and stakeholders' belief on the Treasury management system, that meet the demand of the compliance-focused Islamic banking landscape. So what are your thoughts on this?
Treasury is, the funds or the revenues of banks at the disposal of the bank. So the management of such funds is what is known as treasury management. It encompasses a whole lot of things. It has in it, cash management, reserve management, and even risk management is part of treasury management, because we have said that our funds are our treasures. So we also need to manage the risk associated with those treasures. So risk management is also part of treasury management. So treasury management is the part of managing within the acceptable level of risk the consolidated fund of a bank optimally and profitably. So optimally there and profitably there would mean that we invest in profitable ventures that are Sharia compliant, right? So it is a window through which banks raise funds and place funds for their operations. So we can have them as making investment decisions, financing decisions, and then dividend decisions. We have made profit on this. How do we share? In what manner do we share the profits we have made? Then that's the dividend decision. There. That's all about basically about treasury management. So when we have such framework in place, so it will of course definitely help in improving the growth of Islamic finance.
So looking ahead, what are prospects for the growth of Islamic banking in Nigeria and Africa? So what will be the key drivers?
The underlying prospects of Islamic banking in Nigeria will emerge from a very popular one that's making the rounds now, which is the fact that our Sukuk, the federal government's bond, was oversubscribed. So of course that is in a way is a potential, which means that going forward, the federal government might want to raise further bonds, so which would in a way bring about more developmental funds for the country. Another one is that there is worldwide growth of Islamic finance. Globally, Islamic finance is growing, whether in Europe or in countries that are dominated by predominantly Muslims and those that are not even non-Muslim countries. Islamic banking is growing worldwide. Right? Another reason or prospect is that it can also assist to mainstream the unbanked. The CBN over the years have been talking about financial exclusion and all of this. So having a sound Islamic banking in place, of course, would also help to bring more people into the financial inclusion net. right? It also does well to provide citizens with alternative credit choice. You have multiple alternatives. You can either go to, but Muslims already know that theirs is Sharia compliant financial products. Right? There is also greater public confidence in Islamic banking system in Nigeria and across the globe. Another prospect for Islamic banking is that it can of course develop micro credit schemes. We see several Islamic financial institutions coming up with micro credit schemes for the teeming population of the Nigeria, and thereby helping to reduce unemployment and poverty in the land. So the key pointers for the growth, or drivers for growth, as put forward by some researchers, is that one, we have population, because the demographic factor is there. The population in Nigeria, for instance, is a large one, and we have them fast growing, young, Nigerians, so who are financially, educated and want to invest their money in ethical finances. Another pointer there of driver for growth is economic growth, attraction to investors and property. So this will make it to be attractive to persons to want to invest in ethical finances brought by Islamic finance. Thank you very much.
All right, thank you very much, Mr. Shitta, for sharing your thoughts with us on the program this afternoon.
Thank you for having me.
Have a great day. Islamic finance promotes risk sharing, connects the financial sector with the real economy, and emphasizes financial inclusion and social welfare. Even the 2030 agenda of the World Bank for Sustainable Development that seeks to eradicate poverty in all its forms emphasized Islamic finance to promote responsible and risk-sharing based finance. It is the recognition of the core principles of Islamic finance, providing mechanism for redistribution to address any imbalances that may occur during wealth production and distribution. Islamic finance promotes risk, connects financial sector with the real economy, and emphasizes financial inclusion and social welfare. It is expected that stakeholders in the industry will explore the development of innovative products in the Islamic Treasury management, which is vital to deepen the non-interest finance market and leveraging in Nigeria and Africa. And that brings us to the end of the show today. For more updates on Islamic finance, news, analysis, and reports, log on to www.proshareng.com. Follow us on our social media platform displaying on the screen. Many thanks for watching. Stay safe, stay healthy, and bye for now.